In this part 1 Indian economy GS3 revision marathon, we discussed till now 3 chapters, and now we are going to fourth chapter in this first part. The 3 chapters are employment, inclusive growth, manufacturing were discussed. Then we are going to fiscal, GST and federalism. The fourth chapter is physical sustainability and the quality of expenditure. What is fiscal sustainability and the quality of expenditure? In 2025, UPSC asked physical health index question. Then 2021 it asked capital and revenue budget. 2021 again asked V-shaped recovery. 2020 asked potential GDP, and 2019 public expenditure management, and again 2019 asked steady growth and low inflation. In 2018 LTCG and DDT, and 2017 savings rate, and 2016 that is important one, gender budgeting. 2015 gold monetization. 2013 again important one, FRBM, and 2013 again asked tax expenditure. So 13 PYQs were asked from 2013 to 2025 in this particular chapter. So what is the importance of this chapter? What is the paradox actually? The fiscal deficit is falling. The debit is not falling as fast. And the one deficit measure that improved sharply this year improved because of reclassification. 3 sentences, 3 different claims about the same budget. Hold are all 3. So what is that? The fiscal deficit is falling. The debit is not falling as fast as a fiscal deficit. And the one deficit measure that improved sharply improved because of what? Reclassification. So then we are moving to scene number 2, that is the 4 deficits and what each one hides. What are the 4 deficits? Fiscal revenue, effective revenue and primary deficit. 4 deficits. According to budget estimates 2026 and 2027, we are going to discuss. You have to learn the sequence, not the definitions. The fiscal deficit is 16,095 16 lakh 95,768 crores, which is 4.3% of GDP. It measures what? It measures what? The total borrowing requirement. Measures total borrowing requirement. And then comes to revenue deficit. Revenue deficit is 5,92,344 crores, which is 1.5% of GDP. It measures borrowing to fund consumption, the one that matters for sustainability. Comes to the effective revenue deficit, that is 99,642 crores. This is 0.3% of GDP, and this is showing revenue deficit minus grants for capital assets. Revenue deficit minus grants for capital assets. And then comes to primary deficit. The primary deficit is 2,91,796, which is 0.7% of GDP. This measures fiscal deficit minus interest. Fiscal deficit minus interest. Today's decisions, not yesterday's. Today's decisions, not yesterday's. So you have to read them as a sequence, not a list. First one, fiscal deficit, then revenue deficit, then effective revenue deficit, then primary deficit. This is the sequence. Fiscal deficit tells you how much the government borrows. That is called as total borrowing requirement, not what for. Revenue deficit tells you how much of that borrowing funds current consumption. This is the one that matters for sustainability. Borrowing for consumption leaves nothing behind to service the debit. Borrowing for consumption leaves nothing behind to service the debit. An effective revenue deficit removes grants, removes grants for capital assets into from revenue deficits. Effective revenue deficit removes grants to states that create capital assets. And the argument that the asset exists even though the union's book record a transfer. Primary deficit strips our interest, showing the deficit generated by today's decisions rather than yesterday's. And here is the high value line. The gap between the fiscal deficit at 4.3 and the primary deficit at 0.7 is the interest bill. Is the interest bill that is 14 lakh 3,972 crore exactly at point zero even at 0.7%. India's current year fiscal stance is close to balanced. So the 4.3% is largely inheritance. The survey puts it more sharply, like fresh borrowings are now increasingly used to service past interest obligations rather than to finance current spending. That is the important thing you have to understand. The glide path here is 9.2% of GDP in financial year 2021, then 4.8 in financial year 2025, then 4.4 in financial year 2026, 4.3 in budget estimates of 2026 2027. So this is the path. And the commitment behind it. What is that commitment behind it? In the financial year 2022 budget, the government articulated a medium term glide path targeting a fiscal deficit below 4.5% by financial year 2026. Deliberately not binding, deliberately not binding annual targets, so that capital expenditure would not be squeezed to hit yearly number. That commitment was met. India received three sovereign rating upgrades in financial year 2026 from Morningstar, DBRS, S&P Global Ratings, and Rating and Investment Information, attributed to continued deficit reduction, revenue buoyancy, and the shift toward capital investment. So comes to capital versus revenue and the bridge between them. So the 2021 question asked for the distinction and the components. So you have to answer it, then go past it. The revenue budget. What is the revenue budget? Receipts creating, receipts creating no liability and reducing no asset. To taxes, dividends, fees, and expenditure creating no asset, like salaries, pensions, interest, subsidies, etc. These are comes under revenue budget. Capital budget. Receipts creating a liability or reducing an asset, like borrowings, disinvestment, loan recoveries, and expenditure creating an asset or reducing a liability. So these are comes under the capital budget. The bridge between them is effective capital expenditure. In budget estimates 2026-2027, capital expenditure 12 lakh 21,821 crore as capital expenditure. This is 3.1% of GDP. And grants in aid for creation of capital assets is 4 lakh 92,702 crores. These are grants in aid for what? Grants in aid for what? For creation of capital assets. So together effective capital expenditure, that is 17 lakh 14,523 crores. This is called as effective capital expenditure. This is 4.4% of GDP against physical deficit of 4.3%. So the logic here is, when the union grants a state money to build a road, when the union grants a state money to build a road, the union's books shows revenue expenditure and the road still gets built. So you have to understand this point. What is the logic here? When the union grants a state money to build a road, the union's books shows what revenue expenditure, and the road still gets built. And the trend here is, which is the stronger claim. Capital expenditure rose from an average of 1.7% of GDP pre-pandemic to about 2.9% post-pandemic. So effective capex rose from 2.7% to 3.9, reaching 4.0% in financial year 2025. So what is the knife edge here? Effective capital expenditure exceeds the fiscal deficit by 18,755 crores, which is 1.1%, a margin of 1.1%. Every rupee borrowed is matched almost exactly by an asset creating rupee. So this is the strongest available defense of the borrowing program, and it is the precarious by construction. The whole claim rests on 1.1% of headroom, and one revision stage overrun erases it. Erases it. Use it and cap it, and say it the right way round. Like 17 lakh 14,523 crore against 16,095 16 lakh 95,768 crore is 101.1% coverage. Say yes, margin 1.1% or 1.1% of headroom, never 98.9% coverage. That is the reciprocal, and it reads as thou capex fell short, it did not. So India converts a higher share of a small revenue base into public investment than almost any comparable economy. 19.6% of revenue against the US 10.8, UK 7.7, and Germany 6.1. So this is all about the knife edge, like capital expenditure plus grants in aid, that is equal to what? Effective capital expenditure. Capital expenditure plus grants in aid, for creation of capital assets, that is equal to effective capital expenditure. The effective capital expenditure is how much? 17 lakh 14,523 crore. Then comes to fiscal deficit to how much? 4.3% of GDP. But here effective capital expenditure is 4.4% of GDP. So what is the 0.1%? So effective capex exceeds the fiscal deficit by 18,755 crores, that is 1.1%. Every rupee borrowed is matched almost exactly by an asset creating rupee. That is the strongest defense of borrowing program, and it is precarious by construction. The whole claim rests on 1.1% of headroom, and one revision stage overrun erases it. Sen- So then we are moving to the next scene, that is the quality of expenditure argument. The honestly, the clearest way to show the shift is to decompose the physical deficit itself. What is India borrowing for as a share of the fiscal deficit? In financial year 2020, revenue deficit share is 71.4%, and financial year 2026 budget estimates, that is comes to 33.4%. Then comes to capital expenditure from in financial year 2020, it is 36.0%, but comes to 26 budget estimates, that is 71.5%. So capital expenditure share rose, and revenue deficit share decreasing. So financial year 20, 71% of what union borrowed went to plug a revenue gap. In financial year 26, 70% of what it borrows goes into what? Capital expenditure capital expenditure. Here revenue, here capital. So single reversal is the strongest quality of expenditure evidence available, and it is stated in the survey's own decomposition rather than read of a chart. So the supporting movement, revenue expenditure moderated from 13.6% of GDP in financial year 2022 to 10.9% in financial year 25, below the pre-pandemic average of 11.1%. So major subsidies fell from 1.9% of GDP in financial year 22 to 1.2% in financial year 25, budgeted at 1.1% in financial year 26. And that was achieved alongside free food grains reaching about 78.9 crore beneficiaries as of October 2025. So what is the complication here? Now the complication, and this is where the answer earns its marks. The revenue deficit was 1.5% of GDP in revised estimates 2025-2026, and it is 1.5% in budget estimates 2026-2027. Unchanged unchanged. The effective revenue deficit went from 0.6% to 0.3. Halved 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 The entire movement sits in one line, that is grants in aid for capital assets rose from 3 lakh 8,151 crore to 4 lakh 92,702 crore, up 59.9%. And here is how to say it: the improvement in the effective revenue deficit in 2026-2027 is real in accounting and provisional in economics. ERD improves when grants effective revenue deficit improves when grants are classified as asset creating. Whether the assets are created depends on state execution, which the union does not verify. The headline revenue deficit water, which requires no such assumption, did not move at all. Say both halves. The long run reversal in the deficit's composition is real. The year's ERD, effective revenue deficit is halving, is definitional. So the international comparison worth carrying in financial year 2024, general government investment was 4% of GDP. 4% of GDP, about the one-fifth of total government revenue. General government invest as a share of general government revenue 2023. Indonesia 19.7, India 19.6, the United States 10.8, Canada 8.5, France 8.4, United Kingdom 7.7, Italy 6.9, Denmark 6.1, Germany 6.1, South Africa 5.9, Brazil 5.2. And when OECD countries were at India's current income level, their general government investment was about 2 to 5% of GDP. And tax revenues of 20 to 28% of GDP, far above India's. So India converts a higher share of small revenue base into public investment than almost any comparable economy. That is the sharpest single defense of India's fiscal model, and it belongs in any answer on expenditure quality. So moving to next scene, that is the three denominator warning, that is the interest trap and the debit anchor. What is the interest trap? What is the interest trap? Interest payments, budget estimates 2026 to 2027, 14 lakh 3,972 crores. Now the ratios of that one bill, as they are not interchangeable, as a share of net tax revenue, 49%, 49%. Budget estimates 2026-2027, as a share of revenue receipts, 39.7%, as a net revenue receipts, 36.8%. This is the survey's own measure, net tax revenue plus non-tax revenue, 36.8%. And that one is financial year 25. So write this, not that. What you have to write is three ratios, three denominators, two different years, one interest bill. A student who meets 49 and 36.8 in different places will assume one is wrong. Neither is. Always name the denominator and the name the year. Half of what the union keeps after devolution is committed before a single scheme is funded. So now debt, and you must name the definition. And the center's statement of liabilities for 2026-2027 budget estimates is 54.7% value. And the FRBM Act definition, same year, 55.6. And outstanding liabilities for 25 revised estimates in the survey, 55.7%. So general government center plus states financial year 25 revised estimates, that is 81.1%, and the 2020 and the 2021 peak That is, center was 60.7 or 61.4 depending on the definition. So the FRBM definition additionally values external deficit. The FRBM definition additionally values external debit at the current exchange rate and adds extra budgetary liabilities. And the comparative point that answers is this sustainable. India has reduced its general government debit to GDP ratio by 7.1 percentage points since 2020, while sustaining high public investment. Most advanced economies have seen only limited post-pandemic debit unwinding, and most emerging economies face constrained adjustment space. India is the outlier in the direction that helps. The 2013 FRBM question answered from where the debate now stands. The act was introduced in 2003 to institutionalize financial fiscal discipline by putting numerical targets into statute rather than leaving them to annual political choice. Its central weakness is documented in the survey's own words like this. Since the FRBM Act was enacted in 2003, the 3% fiscal deficit target has been achieved only once. An escape clause invoked often enough stops being an exception. The survey's judgment is blunt. This eroded India's fiscal credibility, and it took 5 years of sustained post COVID prudence to win back the trust of markets and rating agencies. So the anchor changed. The financial year 26 budget announced a new glide path. What is that glide path? Center debit to GDP ratio of 50 plus or minus 1% by 31st March 2031. 31st March of when? 2031. So, why debit rather than deficit? The survey gives three reasons. Debit captures the cumulative effect of past and present fiscal deficit rather than 1 year's flow. It is consistent with global practice, and it is a concrete commitment with a specific data that still allows year to year flexibility in a volatile environment. And the sequencing argument, which is the sophisticated part, the survey explicitly rejected. The survey explicitly rejected reinstating a 3% statutory deficit target now on the grounds that committing to a target the government cannot deliver is what destroyed credibility the first time. A return to a rule-based regime should come after debit and deficit ratios move meaningfully closer to 50% and 3%. Possibly at the end of the 16th Finance Commission period, and note the tension within the commission itself. The 16th Finance Commission recommends the Union reduce its fiscal deficit to 3.5% of GDP by the end of the award period, looser than FRBM's 3%. And a flow target sitting alongside the budget's stock target, naming that both exist and that they are different kinds of role is worth a mark. And the long horizon from the CM Commission, combined union and states debit is projected to fall to 66.1% of GDP by 2043 on the Commission's own path, 68.1% at 10.5% nominal growth, and 64.1% at 11.5. At these debit levels, the growth rate does more work than deficit rule. 1 percentage point of nominal growth moves the 2043 debit ratio by 4 points of GDP. So debit management quality, which almost no answer includes, which almost no answer includes. Sustainability is not only about the level, It is about the structure of the debit. Rollover risk. What is the rollover risk? 27.0% outstanding debit matures over the next 5 years, an average of annual rollover of about 5.4%. Weight, Weighted average maturity of fresh issuance is about 19.14 years. Interest rate risk, floating rate debit is just 4.1% of outstanding debit. The currency risk, external debit is roughly 2% of GDP, 2.6% of GDP, largely multilateral, long-term concessional, and the cost is the weighted average coupon on fresh issuance fell to 6.65% in financial year 2026 from 7.11 in financial year 20 to 7.25 in financial year 25. The formulation, India's debit is high in level and low in risk. Long dated, fixed rate, domestic currency, and falling in cost. That combination is why a 55% ratio here is not the same object as 55% ratio in an economy borrowing short in foreign currency. So then we are moving to next scene, that is fiscal health index. What is physical health index? The 2025 question had two parts. The Now the physical health index assesses state physical performance and how it would encourage prudent policy. So apply the index comparison skeleton from chapter 2. So what is it? A Niti Aayog composite index scoring states and fiscal performance built on controller and auditor general data. The second edition covers financial year 2023-2024 with longitudinal analysis back to financial year 2014 to 2015. What are the five pillars? The five pillars lend these verbatim. Quality of expenditure, revenue mobilization, fiscal prudence, debit index, and debit sustainability. What changed in this edition? The first release covered 18 major states, the second adds 10 northeastern and Himalayan states ranked separately. With the sub indicators refined for difficult terrain, sparse population, limited own revenue capacity, and heavy reliance on union transfers. Jammu and Kashmir is excluded as a union territory. The four tiers. What are the four tiers? Major states, financial year 2023-2024. Achievers. Achievers are what? Odisha, Goa, Jharkhand. Odisha, Goa, Jharkhand. What are the front runners? Gujarat, Maharashtra, Chhattisgarh, Telangana, Uttar Pradesh, Karnataka. Then comes to performers. Who are the performers? Madhya Pradesh, Haryana, Bihar, Tamil Nadu, Rajasthan. Aspirational. Who are the aspirational? West Bengal, Kerala, Andhra Pradesh, Punjab. Odisha remains the top performer. And what separates these tiers? Achievers have an own tax share above 60%, capital outlay around 4 to 5% of GSDP, a fiscal deficit below 3% of GSDP, and debit under 25% of GSDP. Aspirational states show deficit often breaching FRBM norms. Debit roughly 35 to 45% of GSDP, committed expenditure at 50 to 60% of revenue receipts, and interest payments exceeding 15 to 20%. What is the movement here? Bihar improved from aspirational to performer. Bihar. Haryana gained 3 ranks. Karnataka and Telangana slipped to performer. Kerala and Tamil Nadu slipped into aspirational. So northeastern and Himalayan states ranked separately. Comes to achievers, Arunachal Pradesh and Uttarakhand. Performers, Assam, Meghalaya, Mizoram, Sikkim, Tripura. Aspirational Himachal Pradesh, Manipur, Nagaland. And for Tripura, Nagaland and Manipur, central transfers exceeds 80% of revenue. So comes to the one reading gap, the tier names are used twice for the overall index and again within each pillar. Jharkhand is an overall achiever, moves frontrunner to achiever and quality of expenditure, and slips frontrunner to performer on revenue mobilization. So, three true statements. One state, always say which index. The second half of the question, how does an index encouraging prudence? Given it has no enforcement power. So, four mechanisms here. First and foremost, that is comparison creates pressure that statute cannot. Comparison creates pressure that statute cannot. A deficit target is private matter between a state and its own law. A published rank is public and comparative. The second one is it decomposes one it decomposes one failure into five diagnosable ones. Kerala has a fiscal problem, is not actionable. Committed expenditure at 50 to 60% of revenue receipts is. So third one is it rewards revenue effort, not just restraint. An own tax share above 60% is an achiever criteria, which shifts the conservation, which shifts the conversation from austerity to capacity. Then fourth one is it creates a movement narrative. That is, Bihar's rise demonstrates that the tier is not destiny. And the honest limits, no statutory force, no consequence attached. It reports financial year 2023 and 2024 in 2026. So a 2 year lag, so it cannot discipline a budget being framed now. It scores fiscal rather than developmental outcome. A state could improve its rank by cutting developmental spending, and separate northeastern ranking means it is not a single national league table. But the limit that matters most is this: state development loan coupons show only weak differentiation by fiscal health. Borrowing costs neither reward fiscally strong states nor penalize weak ones. The market is not doing the disciplining. That absence is precisely why an index published by Niti Aayog has to try. Then moving to public expenditure management. The 2019 question asked why public expenditure management is a challenge in budget making. Here is the current answer, and it is unusually concrete. The problem here is money released is not money spent. Bulk fund releases to implementing agencies left large idle balances, averaging about 1.67 lakh crore under centrally sponsored schemes, creating inefficiency, diversion risk, and real opportunity cost when the government borrows at around 7% to fund balance sitting unspent. The reform here is just in time fund release, a shift from a credit push model of bulk transfers to a debit pool model where funds move only when expenditure is actually incurred. The two instruments carried SNA Sparsh from 2023 for centralized sponsored schemes integrated with PFMS, state financial systems, and the RBI's e-Kuber, and covering all 28 e-Kuber, and covering all 28 states, 3 union territories, and 73 centrally sponsored schemes. And the treasury single account for central sector schemes, which eliminates advanced transfers. Funds are drawn directly from RBI accounts against assessment assignment limits. And from financial year 25, it applies as to all central sector schemes of 100 crore or more. And here is the result. The single nodal account balances fell from 1.67 lakh crore to in April 2025 to 0.4, that is point for zero point 0.4 lakh crore in January 2026. A fourfold reduction in idle balances is a fiscal gain that appears in no deficit number. It reduces short-term borrowing, saves interest, and closes the diversion window without a single rupee of additional allocation. And the general point here is, which is the answer to the 2019 question. The frontier, the frontier of public expenditure management has moved from how much to allocate to when the money moves and whether it can be traced. Allocation is a budget decision. Disbursement architecture is a governance one. So two more instruments in the same family, direct benefit transfer. So estimated leakage savings of 3.48 lakh crore over the past decade, while beneficiary coverage expanded roughly 16-fold from about 11 crore to 176 crore. Better targeting and wider coverage simultaneously, which is the unusual part. And a nudge here is non-intrusive usage of data to guide and enable. The income tax department's behavioral approach, data analytics identifies likely non-compliance, taxpayers are promoted to correct voluntary, and audits are avoided. The foreign asset campaign prompted nearly 25,000 taxpayers to revise returns, with over 61% responding, declaring foreign assets about 29,000 crore. Section 80 GGC nudges produced over 91,000 updated returns and reduced excessive deductions by about 2050 crore. Why nudge belongs in a public expenditure answer? It demonstrates that revenue administration and expenditure administration are covering on the same principle. Use data to make compliance the path of at least least resistance rather than to catch people afterwards. So if deficit tells you what, a deficit tells you how much government borrowed. Only the composition tells whether it should have. So then we are moving to next scene, that is the budget as a distributional instrument. The three questions 2013, 2016, 2018 share a subject that the budget does not merely allocate. The budget does not merely allocate, it redistributes, often invisibly. Tax expenditure, the 2013 question, revenue foregone through exemptions, deductions, and concessional rates. Functionally, it is a spending program delivered through the tax code, but it does not appear as expenditure, is not voted annually, and rarely faces as outcome review. And the housing example, the question asked for, then deductions on home loan interest and the principal reduces the effective cost of owner occupied housing. The subsidy is real, but its value rises with taxpayers' marginal rate. So it flows disproportionately to higher income households and to those already able to borrow. A visible housing subsidy would be scrutinized for targeting, an invisible one is not. Then comes to gender budgeting, the 2016 question, not a separate budget for women, but an analytical exercise applied to the whole budget. Classifying allocations by gender impact. It appears as statement 13 of the expenditure profile. And there are three parts, not two. First one, part A, that is 100% provision for women and girls, about 21.5% of the gender budget. The part B, 30 to 99% of the provision, about 72.6%. And part C, below 30% of the provision introduced in 2024-2025, about 5.9%. And part C is the newest feature and therefore the most examinable. And note where the weight sits, roughly three quarters of India's gender budget sits in part B. Schemes where women receive somewhere between 30 and 99% of the provision, against about a 15 genuinely women specific part A. That is, the classification is not outcome measurement. Critic with a number behind it. What is that number? The larger the statement grows, the more of its consistency, the more of it consists of schemes whose gender impact is assumed by a coefficient rather than measured. Say the structure, then say where the weight sits, then say what it implies. What it implies. And one advanced point is available for 15 marker on debit sustainability. The survey tests India's debit using a fiscal response function in the bond tradition, that is sustainability holds if the primary balance improves systematically as the lagged debit ratio rises. For India over 1981 to 2024, the coefficient on lagged debit is positive and significant, meaning fiscal policy has historically corrected in response to debit accumulation. The test for sustainability is behavioral, not a threshold. That framing alone will distinguish an answer. A deficit tells you how much a government borrowed. Only the composition tells you whether it should have. So, what are the most probable questions from this chapter according to 2026 mains? So the first one is India has replaced its deficit anchor with a debit anchor of 50 plus or minus 1% of GDP by 2031. Examine the implications for fiscal discipline and flexibility. Why this question? Probable. The framework changed this year. The 16th Finance Commission's 3.5% recommendation sits alongside it, and FRBM has not been examined since 2020, 2013. FRBM has not tested since 2013. The second one is the second question is the improvement in India's effective revenue deficit reflects classification more than consolidation. Critically examine why the effective revenue deficit, that is ERD, halved or halved, while the revenue deficit stood still, specific, checkable, and current. And third one is just in time. Fund release and direct benefit transfer have shifted public expenditure management from allocation to disbursement. Discuss. Why this question? The 2019 question asked about expenditure management, and this is its current concrete form. This is all about regarding chapter number 4. Then we are moving to chapter number 5, that is GST and fiscal federalism. What is GST and why fiscal federalism is important? And we are going to discuss in this chapter very in detailed. So 2020 UPSC asked the Compensation Act, COVID and federal tension. Then 2019, what GST subsumed, a question asked UPSC. In 2018, Niti Aayog and the Planning Commission asked by UPSC. And 2013, the rationale and the delay. And not examined since 2020. So, and the vehicle has been wholly replaced. So, what is the paradox here? The bargain that made GST possible expired this year. Nothing replaced it. And here is the arc to hold for the next 25 minutes because every scene sits somewhere on it. Has GST's federal bargain entered phase 2? Phase 1, states surrender indirect tax autonomy. And phase 2, the compensation guarantee transitions out. And phase 3, rate rationalization, a mature GST and the 16th Finance Commission. So that is the scene number 2 we are going to discuss is why GST and why it took 14 years. The 2013 question asked for the rationale and the delay, both halves. What is the rationale? Four defects of the old regime, that is cascading, tax on tax, because credit could not be claimed across the center state boundary. Then comes to fragmentation, second one. Check posts at state borders and national market that was not one market. And rate chaos. What is the rate chaos? Different states, different rates, different exemptions, and tax competition between them. And origin based taxation, which rewarded producing states and penalized consuming ones. So that is why GST came. What was subsumed? The 2019 question from the center, central excise duty, additional excise duties, service tax, countervailing duty and special additional duty of customs, and central surcharges and cesses on supply. From the states, state VAT and sales tax, central sales tax, entry tax and octroi, luxury tax, entertainment tax, other than local body levies, purchases tax, tax on lotteries, betting and gambling, and state surcharges and cesses. And what stayed out, which matters, that is petroleum crude, petrol, diesel, aviation, turbine fuel, and natural gas remain outside GST. Alcohol for human consumption is constitutionally excluded. Electricity duty and stamp duty remain with states. Now the road to GST. The idea was first proposed in 2000 with an empowered committee of state finance ministers set up to study sales tax reform. The 101st Constitutional Amendment Act was passed and ratified in 2016. Rollout was at midnight on 1st July 2017 and the scope is 17 taxes and 13 cesses subsumed. Name the starting point because the interval depends on it from the first proposal in 2000 to roll out is 17 years. From the Kelkar task force it is 14. Say both 17 years from the first proposal in 2000 and 14 from the Kelkar task force recommendation. To not leave it ambiguous, a student who meets both numbers will assume one is wrong. And the be careful with that word because 17 does two jobs in this scene. 17 years from the 2000 proposal and 17 taxes assumed. So always name the unit. Why 14 years? The delay is the answer to a federalism question, not a technical one. States were being asked to surrender the taxing power that gave them fiscal autonomy, an irreversible transfer in exchange for a share in a pooled tax over which they would have to vote but not a veto. The constitutional amendment required ratification by half the state legislatures. The blocking problem was never the software, it was that no state would move first without a guarantee against loss. A guarantee is the next scene, that is scene number 3, the compensation bargain and its end. The 2020 question asked for the rationale over asked for the rationale of the compensation act COVID's impact on the fund and the federal tensions that followed. All three parts. The rationale, states surrendered the bulk of the indirect taxing power. The GST Compensation to States Act 2017 promised to make good any shortfall against protected revenue growth rate for 5 years from implementation. Funded by a compensation cess on demerit and luxury goods. Without that promise, the constitutional amendment would not have passed. COVID's impact. The pandemic collapsed consumption in the same year it collapsed cess collections. The fund had to compensate more precisely when it could collect less. The center's initial position that the shortfall was an act of God and states should borrow against the state's position that the guarantee was statutory. Produced the sharpest center state fiscal confrontation since GST began. So it was eventually settled through a back to back borrowing arrangement with the cess extended beyond its original 5 years to service that debit. And now it ends compensation cess 1,50,057 1,50,570 crore in 2024-2025 actuals, 88,000 crores in revised estimates 2025-26. Okay, then nil in budget estimates in 2026 and 2027. From budget estimates 2026-2027, the transfers to the GST compensation fund component is removed from the budget entirely to reflect the phasing out of the cess. And there is a trap here. The GST head appears to fall from 10 lakh 46,480 crore in revised estimates to 10 lakh 19,020 crore in budget estimates. That is not a fall in collections. Strip out the cess and CGST rises 6.3% from 9 lakh 58,480 crore to 10 lakh 19,020 crore. So do not write the GST collections are projected to decline. And the cess did not simply expire. The 56th council reforms take effect for everything except one category, and the exception is stated precisely for cigarettes, chewing tobacco products such as Jerda, unmanufactured tobacco, and BD. The existing rates of GST and compensation cess continue to apply. So new rates will be implemented at a later date to be notified based on discharging of the entire loan and interest liabilities on account of compensation cess. So read that what that sentence actually says. The cess was created in 2017 for what? To fund a 5 year guarantee. When collections fell short during the pandemic, the center borrowed to pay that guarantee, and the cess was extended to service the borrowing. The guarantee ended in June 2022. The cess is still being levied on tobacco, not to compensate anyone, but to repay the loans taken to fund the compensation. The cess sentence, what is that? The compensation cess has outlived the compensation it was created to fund, introduced in 2017 to underwrite a 5 year revenue guarantee. It was extended when the center borrowed to meet that guarantee during the pandemic, and it survives today on a single product category, that is tobacco. Where is the government has stated that existing rates continue until the entire loan and interest liability in account of the compensation cess is discharged. India is therefore still levying a cess to repay money is borrowed to pay the compensation that the cess was created to finance. This is the clearest available illustration of a general fiscal federal problem. A temporary instrument creates a permanent constituency, and the exit from it is governed not by the policy purpose that justified it, but by the debit is accumulated. And the headline consequence is the compensation guarantee was the price of GST. It has now been paid in full and withdrawn. From 2026-2027, the state's GST position rests entirely on council rate decisions and their own SGST buoyancy with no union backstop and no statutory floor. So this is the single most consequential fiscal federalism fact of the year. And the honest framing is that is the neutral in law and asymmetric in effect. States with weak consumption bases and low own tax capacity losses a cushion that states with strong bases barely used. So then we are moving to next scene, that is GST 2.0. The 56th GST Council meeting effective 22 September 2025. A two rate structure, a standard rate of 18%, a merit rate of 5%, or sin rate of 40% on a select few goods and services that last one inclusive of the earlier. Compensation cess rate, so there is no increase in overall burden. So say that clause, it prevents a wrong claim. The tripod framing is, which is how the survey presents it. GST 2.0 is the third leg of a tax reform sequence. Corporate tax reductions in 2019, personal income tax reform from April 2025, and GST rationalization from September 2025. So representative rate movements. So agriculture machinery 12 to 5%, key fertilizer inputs 18 to 5, small cars, motorcycles up to 350 cc, buses and trucks 28 to 18, man-made fiber 18 to 5, and man-made yarn 12 to 5, air conditioners and large television 2080 to 18, most everyday essential to 5, nil on UHT milk, Indian breeds and prepackaged paneer, nil on select life-saving drugs, and 5% on other medicines. GST exemption on all individual life and health insurance policies, and renewable energy devices 12 to 5, the inverted duty structure, and this is the sophisticated point. Inverted duty exists when inputs are taxed higher than outputs. Standing. So standing input tax credit and locking up working capital. GS2 2.0 corrects it structurally in textiles and fertilizers by cutting input rates. Residual cases are addressed through automated refunds of unutilized input tax credit. And and honesty check is two slab is the government's framing, not the arithmetic. The operative structure is nil, 5, 8, 5, 18, and 40% plus a continuing cess on specified tobacco. That is 4 rates and SS, not 2. So you have to say a 2 rate core with a nil band and demerit rate. Accurate, still a very substantial simplification from 5 rate plus S, and it does not repeat a press formulation as through it were the tax code. So now GST's performance, and these figures are all from the PIB backgrounder, one source throughout. So gross GST in financial year 2024-2025, that is 22.08 lakh crore, doubled in 4 years. and 18% compound annual rate. Average monthly collections 2.4 lakh crore against 82,000 crore in 2017-2018. So registered taxpayers 66.5 lakh in 2017 to 1.51 crore in 2025. Taxpayer base increased. So gross GST April to December 2025 17.4 lakh crore, up to 6.7% year on year. So e-way bill volumes over the same months up to 21%, and the correlation between GST growth and nominal GDP growth is what? How much? 0.92. And here is the computation. Monthly collections are 2.49 times their 2017-18 level. The taxpayer base is 2.27 times its 2017 level. Revenue has grown slightly faster than that base, which is the evidence for the formalization argument, because it means the new registrations are not merely nominal. If you are challenged on the taxpayer figure, name PIB, the survey surroundings give you a different answer. So never mix the two sources in one answer. How to read only 6.7%. Collections in absolute terms recorded multiple all-time highs during the financial year 2026, even as the growth rate looks modest. So both are truth. Growth tracks nominal GDP almost exactly, and nominal GDP growth is lower because inflation is lower. So a 0.92 correlation with nominal GDP means GST is now a mature buoyancy neutral tax rather than a reform still capturing new base. That is a maturity signal, not a weakness, and saying so distinguish the answers. That rate cuts are expected to be revenue neutral or better through volume and compliance effects. That is a claim, not it as a result. So you have to say it as a claim. The sequence finding, and it belongs to this chapter alone. The backgrounder's case is that lower rates raise complaints, widening the base and ultimately raising collections. That is an assertion about elasticity, not a demonstration. And past rationalizations were narrower than this one. So, but the point that belongs to this chapter specifically is about incidents. SGST is half the domestic tax. States have limited independent revenue instruments, and the rate cut arrives in the same period in which the computation, which the compensation guarantee has ended, and the cess is committed to loan repayment. States absorbed the largest rate reduction in GST's history is the first period in which they had neither the compensation guarantee nor an uncommitted cess to fall back on. So whether that was well judged depends on easily elasticity. Nobody has yet measured, which is exactly the honest formulation for an answer. And one more from the reform package worth a line, that is 90% upfront provisional refunds for exporters, easier registration for small and low risk businesses, e-invoicing, and AI driven risk detection. This is all about regarding and relating GST 2.0. Then we are moving to next scene, that is the divisible pool and the gap nobody mentions. The arithmetic of devolution. Budget estimates 2026-2027 gross tax revenue 44 lakh 4,086 crores. The states share devolved 15 lakh 26,255 crore. That is a 34.7% of gross tax revenue against a finance commission award 41%. Where the gap goes, cesses and surcharges are not part of divisible pool. Neither are union territory taxes nor collection costs. The Finance Commission's 41% applies to the divisible pool, not to the gross tax revenue. And the size of the divisible pool is a decision the union makes unilaterally each time levies a cess rather than raising a base rate. That is one sentence is the cess and surcharge argument in Indian fiscal federalism. And the 16th Finance Commission's own response is procedural rather than structural. It recommends that the union government disclose annually the data on net proceeds as certified by the CAG under Article 279. Transparency, not restriction. And the 16th Finance Commission and year 1. Awarded period 2026-31. Vertical devolution retained 41%. Horizontal formula is where the change is. So 2026 is the first year of the award period 2026-2031. So vertical devolution, the state's share in the divisible pool is retained at 41%. No change from the 15th. Horizontal devolution, and here there is a real change, taking the 15th commission's weighs against the 16th. Per capita income or GSDP distance, 45 becomes 42.5%. And the population on 2011 figures 15 becomes 17.5, and area 15 becomes 10, and forest stays at 10. Demographic performance 12.5 becomes 10. Now on total fertility rate, tax and fiscal effort 2.5 is dropped altogether, and contribution to GDP enters 10. New, the criteria that has never existed before for the first time, a finance commission gives explicitly weight to states' contribution to national GDP. Every previous formula was overwhelmingly equity weighted. Equity weighted. Under the last five commissions, income distance alone drove 45% or more of the divisible pool, and 75% or more was distributed on equity criteria. A high output state was in effect penalized for its output. The 16th does three things at once. It trims income distance from 45 to 42.5. It drops tax effort altogether, and it introduces contribution to GDP at 10%. The reading. What is the reading here? This is a partial. This is a partial and cautious answer to the southern and western states' long-standing complaint that devolution rewards demographic and income underperformance. It is partial because equity criteria still dominate. It is cautious before because 10% is small, but the principle, the contribution counts, has now entered the formula, and once a criteria is in, subsequent commissions argue about in weight rather than its existence. So grants and physical rules from the same award, local body grants 7 lakh 91,493 crores in total, split 80% basic and 20% performance. State fiscal deficits capped at 3% of GSDP to be strictly enforced under Article 293, Clause 3, with SCA, SCI on lending over and above that limit. Above that limit. The union too reduces its fiscal deficit to 3.5% of GDP by the end of the award period. None of budget borrowing states should discontinue them entirely and bring all such borrowings onto their budgets with CAG disclosure. And what ends? Post-devolution revenue deficit grants go to nil in budget estimates 26-27 from 13,705 crore in revised estimates. So health sector grants go to nil and two new urban heads appear, a special infra component at 6,000 crore and an urbanization premium at 2,000 crore. The composite picture what? Grants down, urban tilt up, revenue deficit support withdrawn entirely, and a formula that for the first time pays something for output and the loan turnout. The special assistant to state for capital investment, 50-year interest-free loans to states for capital expenditure, launched October 2020. The total uptake 4,49,845 crores from financial year 21 to 26. Budget estimates 2026-27 1,85,000 crore, up from 1,44,000 crore in revised estimates 2025-2026. And of the financial year 26 allocation of 1.5 lakh crore, roughly 68,000 crore united, 80,000 crore reform linked and sector specific, and 2,000 crore for states with exceptional revenue shortfalls. What SCA reveals, states capital outlay rose from 2.17% of GDP in financial year 22 to 2.37% in financial year 2025. This is the headline. So excluding SCI, it fell from 2.11 to 1.92%. The entire increase in state capital expenditure is union money. Without SCI, states were compressing investment. Three consequences. What are those consequences? And they are the argument. First one is the union's principal instrument for state capex is now a loan, not a grant. It sits on state balance sheets and counts against state debit even though it is interest free. And the second one, it is conditional on reform milestones for more than half of the allocation, which shifts sectoral priorities from the state choice to union design. Union design. And the third one is lower income states rely on it most, which makes it genuinely equalizing and simultaneously makes the fiscally weakest states the most exposed to union decision they do not control. And the counterweight, the survey names, states are expanding unconditional cash transfers, estimately at roughly 1.7 lakh crore in financial year 26, FY26, and about half of those states in revenue deficit. Then committed expenditure like salaries, pensions, interest, subsidies already absorbs of about 62% of states' revenue receipts. So the fiscal federal picture is a scissor. The union finances state capital spending through conditional loans while states commit their own revenue to unconditional transfers. Neither side is choosing what it would choose alone. And as chapter 4 showed, the market is not doing the disciplining either. And the moving to the next scene, that is Niti Ayog and the Planning Commission. The 2018 question asked how the principles differ. Answer with the principle, not the dates. Both rest on the executive resolution. The Planning Commission in 1950, Niti Ayog in 2015. But the Planning Commission allocated plan funds to states. Niti Ayog allocates nothing. Nothing. The commission worked through top-down targets. Niti works through cooperative and competitive federalism. The commission's instrument was the 5-year plan. Nitis are strategy documents, indices, and technical advice. And under the commission, states were recipients. Under Niti, they are governing council members. And here the strongest available evidence for the cooperative federalism claim from this year, the 56th GST Council's recommendations, the largest rates restructuring since 2017 were reached, and the consensus of all members is a period of actual is a period of acute fiscal stress for the states. State it alongside the fact that states had no compensation backstop while agreeing to it. A body that produces unanimity on a revenue reducing decision when its members have no safety net is doing something a purely advisory forum would not manage. But the single most important difference is the one candidate's omit, that is, Niti Aayog has no financial powers. The Planning Commission's influence came from its control over plan transfers. Removing that function was the reform. And it is also the limitation. An advisory body persuades, it does not direct. And the answer that takes a position, Niti Aayog is real. Niti Aayog's real instrument turned out to be a measurement. The Fiscal Health Index in Chapter 4, the SDG India Index, the Multi-Dimensional Poverty Index in Chapter 2, the Aspirational District Program, all work by publishing simply comparative performance, comparative performance, rather than allocating money, whether that is a stronger or weaker level. The plan transfers is the arguable core of the 2018 question, and a good answer takes a position. The defensible one, publication creates competitive pressure that money never did. But it cannot compel a state that is content to rank low. So India's fiscal federalism has moved from sharing revenue to sharing conditions. So what are the most probable questions for 2026 here from this chapter? First one, the phasing out of the GST compensation cess marks the end of a transnational bargain. Examine its implication for its state's finances and why. Why this question probable? The cess goes to nil this year. GST has not been examined since 2020, and the corpus shows dormancy plays a live vehicle predicts return. And second one, the 16th Finance Commission has introduced contribution to GDP as a devolution criteria. Discuss its significance for equity and efficiency in fiscal federalism. Why this question? A first in the history of commission, the awards first year. Awards the first year. Third one, union support for state capital expenditure has shifted from grants to interest-free loans. Critically examine. Why? This question probable. SCI now accounts for the entire increase in state capex, and the investment model's head is separately dormant. So these are all the possible, probable questions from this chapter. The entire part one, we are learning few closing lines. That is, India's employment problem is not the people are not working. It is that work is not paying. An average claim about a country, a distortion is a claim about its people. And India's manufacturing problem is not that it makes too little. What is that problem? It is that it captures too little from what it makes. And a deficit tells you how much a government borrowed. Only the composition tells you whether it should have. And the fiscal federalism has moved sharing revenue to sharing conditions. So this paper does not reward what you know about the Indian economy. It rewards what you can argue about it. So this is all about the particular chapter from first chapter to part 1, that is first chapter to fifth chapter. So remaining part 2, that will be going to discuss in the next class. Thank you.